We're all seeing very bad negative news about state of economy while the stock market is up or keeps going up. And I wanted to use Apple as an example that released their Q2 earnings last week, saying how despite COVID-19, they have grown their revenues, and to put money in the back of shareholders' pockets, they're going to do a $50 billion stock buyback. So we're going to talk about what stock price actually represents, what are the valuations, and what are stock buybacks and how they influence companies' value, and especially what has been happening in the past 10 years. Let's firstly quickly look at the top line numbers, and I still spread it out by the products that Apple sell. And you can see that the sales of iPhones went down, which is kind of obvious. They've been going down before the COVID-19, but now when their stores are closed, you can expect that drop in iPhone sales, but they made it up with their wearables and services. So the net income for the quarter did go up, not exponentially, not super significantly, but what Apple is saying, this is actually a great result during the crisis. So before we dive into it, we still got to think about it and remember that this includes first few months of the year when there was still no COVID-19, and perhaps the next few quarters are going to show us a very different picture. But let's dive into the video and see what stock buybacks actually are. Let's quickly go over the market fundamentals and understand what stock price actually represents. So one stock is one share of a company. When you buy it on the open market, you own a share of a company and you can participate in its profits or losses. The next thing you will see in the financial reporting will be market cap, and for Apple it's $1.3 trillion. And that's calculated pretty easily. You take all of the outstanding shares and you multiply it by a stock price. And that leads you to the total market cap, which equals company's valuation. And it's important to understand that valuation is separate from company's assets. Valuation doesn't equal assets. What valuation is expectations of investors of all of the future cash flows from the company discounted to present value. And that's the time value of money. If you didn't see that video, check out the description below. Valuation is future looking, and it doesn't matter if investors expect that the profits are going to grow or they're going to shrink or current economic situation is negative. Investors are looking at the future and trying to predict what's going to happen. So you can see right now that the economy is really not performing well, but the stock market is not following it, and it's because, again, it's future looking. And that's why they say when you look at the stock price, all of those negative or positive news, they're all priced in. Now let's understand how a company can possibly use its free cash. Say it's making money and they're making enough that they already have enough cash for the operational cash flow to pay the salaries, to produce the goods they're selling, and all of a sudden they have that extra cash accumulating. So number one, of course, they can just keep it in reserve, but once you get too much cash, investors are going to get worried why you're not using it to make even more cash. The next thing, they can buy other companies to try and scale and grow. But markets know through the history that mergers and acquisitions rarely result in increased shareholders' value. So that's kind of a risky option. They can invest in their research and development to produce new products or new features. That is not guaranteed as well. R&D can be pretty dangerous and risky. They can use it for capital expenditures. So for example, they could build a new plant to produce iPhones faster or to produce more iPhones. But for example, if right now they already have enough plants and the demand for iPhones is really not increasing, they might just not need it. So the next thing what they can do and what shareholders really love is return the money to the shareholders, to the owners of stocks. And fundamentally, they have two ways to do it. They can pay dividends, which is basically all of the leftover of the net income. They can decide to just separate it to the shareholders, or they can do stock buybacks. And this is the topic of our video. And the next slide, let's just look and see what stock buybacks are. What are buybacks? So company decide there is no good use for their cash, they can't use it for investment or to grow their efficiency, and the best use of their cash is to give it back to the shareholders. So what they do is they purchase certain amount of shares outstanding, whether on the market, and then they retire the shares, making overall less shares in the economy. And they can do it two ways. They can just buy it in an open market, especially if they think the price is low, or they can do what's called a tender offer, where they offer existing shareholders a premium price higher than the market value to purchase their shares. And that's the first way how the shareholders can benefit from stock buybacks, but not the only way, because once we reduce the total amount of shares, all of the ratios where the amount of shares are kind of dividing the upper number, whatever it is, all of a sudden they improve, which looks like the financials are looking better, which can put the price of the stock up. And the number two is, if you think about supply and demand model, and if demand stays the same, but all of a sudden the supply is decreased because there is less shares, that's going to put the price of the stock up as well. And that's a second way how shareholders can benefit from it. So keeping those fundamentals in mind, and I want to add another piece of information, that Apple is the company that made most amount of stock buybacks in past 10 years on the market. Let's look at their financials and see if the theory of the stock buybacks actually works in real world. So we'll see here numbers from 2015 to 2019, and the first line is the net income. And net income is all of the money they earned after they paid taxes and everything. And you can see that in 2016 and 17 it actually went down from 15, and 2019 it is higher than 5 years ago, but not exponentially higher, like slightly higher. The next line is how many shares outstanding are there in the market. Those are in millions, by the way. And you can see that this number is decreasing throughout the years, which is indicative of them buying back the stocks and retiring them. And the next concept I want to introduce is earnings per share, which is basically taking the earnings and dividing them by the amount of shares, which gives you this ratio. And if you remember high school math and you know that this number is smaller, you can expect the EPS to go up and improve without fundamentally changing anything in business or without fundamental growth in the net income. And there are two things with EPS. First of all, this is one of the ratios that investors are looking at to evaluate how attractive the company is and how they're improving over the time. And we hope that investors are smart enough to understand that this change in EPS is not real change, it's just change because of the stock buybacks. Another issue that's what's kind of makes it a conflict of interest is that a lot of executives get paid with the bonuses based on earnings per share. So like they're tied to it. So when you think about you being an executive and you can get this major bonus when your EPS increases, you can either increase the net income by improving the business, or you can reduce the amount of shares. So that creates a conflict of interest that instead of actually growing the business, investing in a business, all they do is reduce the amount of shares to increase the EPS to get their bonuses. Now let's look at the bigger picture and try and understand the valuation of the company in past 5 years changed exponentially, even though the net income didn't. So we know those are the first three lines from the previous slide, that EPS did improve, But we're thinking that investors are smart enough to understand that they only improved because the share amount got decreased. And now the next line is the stock price, which again is the opinion of investors about all of the future cash flows discounted to present value. And you can see in 2015 it was less than $100, and when I recorded this video it was $289, which if you look at the percentage change from 2015 to right now, it's 182% growth. And I can guarantee you there is no 182% growth in the net income, which tells us a few things. It tells us that investors are expecting those cash flows to come from somewhere, and perhaps those are the stock buybacks. They don't expect the cash flow to come from the business activities, but from other ways they can get money through dividends or stock buybacks. And I wanted to introduce another ratio here, which is called price to earnings, which is share price divided by EPS. That's the ratio from the previous slide. And it kind of gives you a quick overview of how companies valued at any moment. So you can think about it is if you would have bought the whole company with its current net income, how many years will it take you to break even? So in 2015 it was 10.5, and right now it's like 28. So if you would have bought Apple right now for $1.3 trillion, it would take you 28 years with the same net income to break even. And again, like that just shows you that even though the net income stayed largely almost the same, the valuation went crazy. So next thing you might say that perhaps all of the market went up, and it doesn't really matter what the company does. When the ocean rises, all of the boats rise, and we got to look at it in the context. So Apple is part of S&P 500, and I looked at the numbers for the same years for how much, if you would have bought the index of S&P 500, how much did they grow? And those are the numbers, the growth for Apple from previous slide. You can see in 5 years it grew by 182%. And when we look at S&P 500, it did grow, but by only 56%, which is a lot. It's not only, but you can see Apple outperformed the index like 3 times, more than 3 times. Which again brings us back to the question, what did they do with their business to deserve that valuation and to deserve to outperform the market when we know that the sales of iPhones are declining, that net income is largely the same? Why is that happening? So now when you understand what stock buybacks are and how it influenced Apple's valuation and Apple's price, and I know it's not the only variable that goes into, but in my opinion it's one of the major variables, because that's what investors been expecting from Apple, to do those buybacks and increase that value. And that's why Apple's valuation at the time of this video is 28 times their income. So when you think about it and you try to understand stock buybacks actually good or bad for the business, some of the questions I kind of ponder and I suggest for you to think about it. Did business fundamentally change? Because if your stock price keeps going up, your valuation keeps going up, if your business did not fundamentally change, so when we talk about Apple, their number one seller is iPhones, and we know it's declining, then this valuation sooner or later is just gonna drop way down unless company does something to change it. And Apple is getting into wearables and services, but right now it's not a fundamental change. There is no real innovation. So when you evaluate again the current valuation of Apple, perhaps is overvalued, because if they're not changing the business that much, like why did the valuation go so high? So that's like number one question that I always think about when buying the stocks, or kind of thinking about, is the company priced right now on the market? The next problematic thing with stock buybacks is Apple is a great company. It has a lot of cash and they're trying to get to the cash neutral position where they just have enough to pay for their operations, but they're not stockpiling cash in their bank account. But there are other companies that are doing the buybacks without actually having cash or without having a lot of cash. And the great example of it are airline companies. And if you look at American Airlines, they actually had a negative free cash flow in past 10 years, yet they're number one airline company that did the stock buybacks. So you can, knowing everything we discussed, you can see that they kind of artificially are keeping the stock price up because of those buybacks without even having the money in the company. So as an investor, you might earn in a short term because their stock price is going up, but you also got to realize those guys actually have no money. They're using debt to pay for those buybacks. So that's like, is that a scam? Like why, like how can it be possibly good in the long term? Now the videos I'm recording is during COVID-19. Does the company have reserves for the extraordinary events like the crisis that we have right now? And I'm including the slides about the airline companies because of course right now they're asking for the government bailouts, yet they spend most of their free cash flow buying back their stocks for past 10 years to increase the valuation of the company without fundamentally changing the business. So I guess the question is, do they even deserve the bailout? But the question for you as an investor, when you look at all of this, you got to know that this is not sound fiscal policy from the company's perspective. Which brings me to the last and major question, is that as stocks artificially high for past 10 years, so 12 years after 2008 financial crisis, we've seen everybody's value going up, we've seen those valuations going up, and is that artificial? Did the business not change that much? And in my opinion, the stock buybacks is a big reason why market had that kind of a rally, why the all kind of went way up. It doesn't make sense to me because again, the fundamental business didn't change. And right now, when the companies are going to be strapped for cash because of COVID-19, they're probably not going to be able to do those stock buybacks. And my expectation that will be one of the reasons is why the stock market is going to go down, especially towards end of the year, when investors looking forward now will know they can't expect that cash flow from the stock buybacks. And I'm leaving it to you to now know what it is and evaluate for yourself. What do you think about stock buybacks? Are they good or bad for business short and long term? Thank you for watching.